What if I told you that the Fed's rate cuts won't save the housing market in 2024? That's right, the Fed's rate cuts, which are supposed to make buying a home more affordable and attractive, could actually backfire and make buying a home more unaffordable and unattainable for many Americans. How is that possible? And what can we do about it? In this video, I'm going to reveal the two major stumbling blocks that could prevent the Fed's rate cuts from saving the housing market in 2024, and the possible solutions and strategies that could help increase the supply of homes and revive the housing market in 2024. This is a very important topic, especially if you're thinking of buying or selling a home in the near future. So, without any further ado, let's get started. The Federal Reserve embarked on a series of rate hikes in 2022 and 2023 in an attempt to tame the inflation that threatened the economy. The Fed raised the federal funds rate, which is the interest rate that banks charge each other for overnight loans, multiple times. This had a ripple effect on the mortgage rates, which are the interest rates that lenders charge borrowers for home loans. Mortgage rates soared to levels not seen in decades, reaching a high of 8% in October 2023. This was a significant challenge to the housing market, which was already grappling with high home prices and low inventory. Higher mortgage rates made buying a home more expensive and less attainable for many Americans, especially first-time buyers and low-income buyers. As a result, the demand for homes decreased, and so did the sales. The Fed realized that its rate hikes were hurting the housing market and the economy and decided to pause its rate increases in December 2023. The Fed also signaled that it may cut the rate in 2024 if the economic conditions warrant it. Many market watchers and experts predict that the Fed will make its first rate cut in the second quarter of 2024 and possibly more cuts later in the year. This may sound like good news for the housing market, as lower Fed rates could lead to lower mortgage rates, which could make buying a home more affordable and attractive for many Americans. However, there are two major stumbling blocks that could prevent the Fed's rate cuts from saving the housing market in 2024. These are inflation and supply. Inflation is the general increase in the prices of goods and services over time. It reduces the purchasing power of money and erodes the value of savings and investments. The Fed's main goal is to keep inflation at a moderate and stable level, around 2% per year. However, inflation has been fluctuating in recent years, reaching a peak of 9.1% in the latter half of 2022, and was at 3.1% in January 2024. This was mainly driven by the rising costs of energy, food, housing, and transportation, as well as the supply chain disruptions and the labor shortages caused by the pandemic. High inflation poses a serious threat to the economy and the housing market, as it reduces the real income and wealth of consumers and businesses, and increases the uncertainty and risk in the market. High inflation also puts pressure on the Fed to raise the rate rather than lower it, to curb the inflationary forces and protect the value of the dollar. If the Fed raises the rate, it will reverse the effect of its rate cuts and push up the mortgage rates again, making buying a home more expensive and less appealing for many Americans. The second stumbling block is the supply of homes. The supply of homes is the number of homes available for sale in the market. The supply of homes affects the balance between the demand and the supply, and thus the home prices and sales. When the supply of homes is low, it means that there are more buyers than sellers in the market, which creates a seller's market. In a seller's market, the home prices and sales tend to rise as the sellers have more bargaining power and can ask for higher prices. When the supply of homes is high, it means that there are more sellers than buyers in the market, which creates a buyer's market. In a buyer's market, the home prices and sales tend to fall as the buyers have more bargaining power and can ask for lower prices. The supply of homes has been very low in the past few years, as the home builders have not been able to keep up with the demand for new homes. The home builders have faced many challenges, such as the rising costs of land, labor, and materials, the regulatory barriers, the environmental issues, and the lack of financing. The low supply of homes has contributed to the high home prices and the low home sales in the market. The Fed's rate cuts could stimulate the demand for homes, as lower mortgage rates could make buying a home more affordable and attractive for many Americans. However, if the supply of homes does not increase, the Fed's rate cuts could also exacerbate the imbalance between the demand and the supply and push up the home prices even higher. This could make buying a home more unaffordable and unattainable for many Americans, especially the first-time buyers and the low-income buyers. Therefore, the Fed's rate cuts won't save the housing market in 2024, unless they are accompanied by a significant increase in the supply of homes. This would require a concerted effort by the home builders, the government, and the private sector to address the various challenges and barriers that have been hindering the home construction and home ownership in the country. So now, let's talk about how can we increase the supply of homes and revive the housing market in 2024. Well, there are no easy answers, but there are some possible solutions and strategies that could help. Let's take a look at some of them. One solution is to increase the production of new homes. This would require the home builders to ramp up their construction activity and overcome the various challenges and barriers that they face. Some of these challenges and barriers include: Number 1. The rising costs of land, labor, and materials. The home builders have to deal with the increasing prices of land, which is scarce and expensive in many urban areas. They also have to cope with the rising wages and the shortage of skilled workers, especially in the construction sector. Moreover, they have to pay more for the raw materials, such as lumber, steel, concrete, and copper, which are in high demand and low supply due to the global trade tensions and the supply chain disruptions. Number 2. The regulatory barriers. The home builders have to comply with the various local, state, and federal regulations and codes, which could be complex, inconsistent, and time-consuming. These regulations and codes can affect the zoning, the permitting, the environmental impact, the design, the quality, and the safety of the new homes. They can also add to the costs and the delays of the home construction. Number 3. The lack of financing. The home builders have to secure enough financing to fund their construction projects, which can be difficult and costly in the current market conditions. They have to deal with the tight lending standards, the high interest rates, the low profit margins, and the high risks of the lenders who may be reluctant to lend to the home builders, especially the small and medium-sized ones. To address these challenges and barriers, home builders need more support and incentives from the government and the private sector. For example, the government could provide tax breaks, subsidies, grants, loans, guarantees, or other forms of financial assistance to the home builders, especially those who build affordable and energy-efficient homes. The government could also streamline and simplify the regulatory process and reduce or eliminate the unnecessary or excessive regulations and codes that hinder the home construction. The government could also invest more in the infrastructure and the public services, such as the roads, the bridges, the transit, the water, the sewer, the electricity, and the broadband that are essential for the new homes and the new communities. Another solution is to increase the availability of existing homes. This would require the current homeowners to sell their homes and enter the market, which could increase the inventory and the turnover of the homes. However, many homeowners are reluctant or unable to sell their homes for various reasons. Some of these reasons include: Number 1. The low equity or the negative equity. Some homeowners have low equity or negative equity in their homes, which means that they owe more on their mortgages than their homes are worth. This can happen when the home prices fall, the mortgage rates rise, or the homeowners borrow more against their homes. This can make selling their homes difficult or unprofitable, as they may not be able to cover the costs and the fees of the sale or pay off their mortgages. Number 2. The high costs or the lack of affordability. Some homeowners have high costs or lack of affordability in their homes, which means that they spend a large portion of their income on their housing expenses, such as the mortgage payments, the property taxes, the insurance, the maintenance, and the utilities. This can make selling their homes unattractive or impractical, as they may not be able to find or afford another home that meets their needs and preferences, or that is in their desired location or neighborhood. Number 3. The sentimental attachment or the lifestyle preference. Some homeowners have sentimental attachment or lifestyle preference in their homes, which means that they have strong emotional ties or personal reasons to stay in their homes. This can happen when the homeowners have lived in their homes for a long time, or have raised their families, or have built their memories, or have customized their homes. This can make selling their homes undesirable or unnecessary, as they may not want to give up or change their homes or their lives that they love. To address these reasons, the current homeowners need more motivation and assistance to sell their homes and enter the market. For example, the government could provide tax incentives, such as the capital gains tax exclusion or the mortgage interest deduction, to the homeowners who sell their homes and buy another home within a certain period of time. These are some of the possible solutions and strategies that could help increase the supply of homes and revive the housing market in 2024. However, they are not the only ones, nor are they the definitive ones. There may be other solutions and strategies that could work better or differently, depending on the market conditions, the consumer behavior, the policy environment, and the technological innovation. The key is to find the right balance and the right combination of the solutions and strategies that could address the root causes and the underlying factors of the low supply of homes, and that could meet the diverse and dynamic demands and expectations of the home buyers and the home sellers in the housing market. That's it for this video. I hope you enjoyed it and learned something new and interesting from it. If you did, please hit the like button and let me know what you think. I would love to hear your feedback and opinions. Also, please subscribe to my channel and turn on the notification bell so you don't miss any of my future videos. Thank you for watching, and I will see you next time.